Hello, everyone. Welcome to our webinar on paying the tuition bill. We're glad that you have joined us here today, and we're going to be going over some of the ins and outs that you might be facing. Just to introduce myself, my name is Jen Fries. I am a certified credit union financial counselor. I'm the community engagement manager for the Harvard Federal Credit Union. And I do have a child in college right now, so I'm there in the trenches with you paying the tuition bill. So I know what that feels like as a parent. Just a little bit about the credit union for those of you who may not know. I know many of you on this call are already members. But just in case you don't know, Harvard Federal Credit Union used to be known as Harvard University Employees Credit Union. We changed our name last year and broadened our eligibility a bit. So credit unions do everything that banks do. You can have a credit card, checking, savings, CDs, all the things, student loans, etc. But we, instead of our purpose being to make a profit for shareholders, our purpose is to do the best thing for the finances of our members. And I know for a lot of people right now, that's something really important, that we are community owned, owned by our members, and here for you and for each other. I'm a member as well. Once you're a member for life, meaning even if you close your account, you can come back, reopen that account. So if there's anything that's prompting you wanting to come back, we would love to have you back. We do have convenient online banking and banking on the app. So even if you're not in the area anymore, you certainly can use all of our banking services. We even have something where you can walk into other co-ops and credit unions around the country and do something called shared branching. If you want to see someone in person and bank in person for something, that's a great option if you're living elsewhere. So hope that you know all about your benefits of being a credit union member, and you can check that out. So just to kind of set the stage a little bit, this presentation is primarily geared toward parents of a student heading to college, but we do also have content here that will be applicable to adults. If you yourself are returning to college or going to graduate or professional school, we will cover graduate loans as well, and some of the things that you need to take care of. So our first step, I guess the thing that I want to make sure that everybody is kind of thinking about is having a honest conversation between the student, who in this case may be a college student or a high school student heading off to college. So the conversation between the student, the parents, as well as some families might want to bring in step parents or grandparents to this conversation or other family members. What are the expectations and what do you feel comfortable doing in terms of helping pay the tuition bill? I think it's really important that those kind of conversations are transparent for students so that they know what costs are going to be shared. Nobody has any surprises. Some families, for instance, might tell their student that they're willing to pay half of the cost, or that they're willing to pay what they would have paid at a state school, wherever the student chooses to go, so that the student then knows they would have to take more loans. You may be able to pay a certain amount per year or per month, and you could tell your student that. If you see a way to free up money in your budget or have savings, and we're going to talk all that through. So once you have that conversation, it's going to be a lot clearer for everyone about choices that they want to make and how to divide up the cost and the burden. So let's talk a little bit about that cost. It can be really confusing to figure out what is the true cost of going to college in the United States. Also, this presentation is going to skew very heavily to the United States. Obviously, things are different in many other countries where there might be free or subsidized, fully subsidized tuition. So every school does publish in the United States, publishes their billed costs every year. Sometimes you're looking at last year's numbers, and so you might need to estimate a little bit, but this will give you a very realistic number to start with. Their published costs, billed costs, are going to include tuition, room and board, meal plan, parking, health insurance, all the things that are required fees. So that will give you a sense of what you will be paying overall before any financial aid. So then, very important, then you're going to subtract any financial aid. This could be financial aid offered by the college or university. These are sometimes known as institutional grants or scholarships. And the important thing to know is that institutional grants or scholarships, or any scholarship, is something that your student will not have to pay back. So those are really important resources for many students. You may be able to identify private scholarships, perhaps through your union, through your student's high school or your city, any clubs or activity scholarships. All of those are going to take money off the cost. Sometimes they're one-time scholarships, and sometimes they continue throughout the student's tenure in college, so long as they maintain a certain GPA typically. And then finally, the financial aid package will include loans, which your student will need to accept or decline, depending on their needs. So this package includes federal student loans of $5,500 before fees, and we'll talk a little bit more about loans and some of the ins and outs of that. Also, of note, so then this student has a total expected bill of $25,000 for the year, approximately. So they can estimate that over 4 years, it's going to cost about $100,000 after scholarships. So that's going to give them a good realistic expectation of what to expect. And I do want to call out specifically that if your student is eligible for federal work study, federal work study is a program where students who are eligible can get a job on campus, sometimes with a local nonprofit as well, that's approved for the federal work study program. The student works a job, that those monies are paid directly to the student in wages. Most students use it for spending money. So they might use it for travel back and forth to get home on a weekend, or for any food that they're getting off campus, or those clothing or something like that. The student can choose to apply that money toward the tuition bill if they want, but that's not going to happen automatically. So you need to know that sometimes they'll show the federal work study amount as part of the financial aid, but that amount is not going to come off of your bill unless you take those wages and literally pay them to the school afterwards. So I also like to give just a reality check or comparison cost, just because I do happen to have a student, my child, who is in state, paying in-state tuition at our state school, UMass Amherst. So just in case you're curious, if people on this call are going to have students at their local state college or university, or particularly at UMass Amherst, I think it's a nice, just helpful to kind of know how that would play out. My students' billed costs this year were $16,664 per semester for room, board, tuition, all the fees. So about $33,000 per year. They did receive approximately $17,000 last year in scholarship aid from UMass and from the state's John and Abigail Adams grant program. So after that financial aid came off, their billed costs were about $8,000 per semester, or $16,000 per year. So a little less than this example on the screen. So just for you to kind of know what you might be looking at. And obviously those costs vary depending on your state schools. Some of them are less expensive for in-state, such as California. Some of them might be more expensive. But that kind of gives you a touch point, I guess. So for most colleges and universities, you are going to be paying that tuition bill twice a year. So there will be an amount for the fall semester that's typically due sometime in July or August. And there's going to be an amount for the spring semester. And, this slide says November, December, but as I recall, ours is actually December. Well, I guess it's late December. So, you do want to know when your school's deadlines are, because if you don't pay on time, your student may be barred from registering for classes and from doing other things they may need such as moving into housing or finalizing something about their housing. However, life does happen. If there's something that a payment is going to be delayed for some reason, do reach out to or keep in contact with your college's bursar's office. The bursar's office is the one that handles all the billing. So if you anticipate any difficulty, reach out to them about that. And keep in mind, if your student takes a summer class or a winter session class, that will be an extra cost. For example, my child took a winter class during the January break, so they did get a full, class credit for that. It was an extra $1,735 this year. A summer class at UMass is about $2,200. So you can kind of keep that in mind. And we're going to talk about billing options later, but although they're typically billed into chunks, we'll talk to you a little bit about monthly billing plans too. So before we get to that though, I just want to talk about, there are some ways to think about reducing your costs. There may be options for, there may be sibling discounts at your college or university if you have more than one child in college at the same place. You may have the option to waive health insurance. My child, being in state and having doctors close by that are eligible with our existing family health plan, we were able to waive health insurance from UMass. So normally that would be about $2,200 per year that we would be paying for UMass health insurance. However, we elected, she was already on a family plan anyway, so there was no additional cost for us to keep her on the family plan. So that does save more than $2,000 a year off our tuition bill to keep the student on home health insurance. That won't work if your student is going to be somewhere far away. And we did call and verify that UMass Health Services would accept my students' insurance. So that's something you're going to want to do as well, or find that out before you make a decision about waiving. If your student has been at a high school that offers dual enrollment and they've had college credits that they earned, those credits are likely to transfer over and might mean that your student could graduate early and could save maybe a semester's costs, and that would be great. Advanced placement classes are a little bit different. Some schools only recognize advanced placement in terms of moving you ahead. You might be able to skip Calculus 1 and go right to the 200 level calculus because of your AP, but they typically, many schools will not give you credit for your AP classes, meaning it won't count toward the credits for graduation. But again, that does vary by school, so you want to take a look at that as well. So yeah, that may be something that you want to look into. Another savings that we did that actually we didn't choose, but was chosen for us is many colleges are having a housing crisis, and UMass is one of them. So my student for freshman year was put in something called a forced triple. And that's when they have a double room, a room that's supposed to be for two students. However, they just cram an extra student in there, another a bunk bed. And so it's been commandeered to make it a triple. That was not the ideal circumstances for that. It was just for one semester, as it turned out. However, we did get a $1,670 credit that semester off our housing costs. So something to be said for that. And there are students who will try and choose a forced triple for that reason. So that's something that could be a possibility. And in general, there may be some dorms that are more expensive or less expensive, and you can kind of look at those depending on your needs and your budget. Um, so we talked about transfer credits, summer term, there may be ways to kind of advance your student along so that they can graduate earlier if that's something that they're interested in. And then finally, in addition to looking for private scholarships that we already talked about, your student may be able to become a resident advisor, or sometimes known as an RA. There are different names for this at different schools, but it's basically the person in a dorm who is a peer who has for a job helping out in some way at the dorm. They might have desk hours that they have to be there at a desk. They may have other duties that are associated with it. So if your student tends to be helpful, like welcoming other people, that kind of thing. A member of my family, my sister-in-law, actually was an RA and had free housing at UMass. So that is definitely a way to take a big chunk off your tuition bill if that is something that appeals to your student. And there may be also scholarships available at your university, college or university, for returning students. There is often a portal within the college or within the for instance, at my kids' school, it's the College of Natural Sciences. They have a portal for scholarships. You can check it, see if there are any that you might be eligible for, and apply. So even if you didn't get scholarships for that freshman year, or if you had scholarships that expire, many are just one time, maybe you can look and find something that is a scholarship for subsequent years. So that is something that you want to keep your eye out for. Harvard FCU also has a scholarship program. We have actually finalized the scholarship for this year. We're about to announce 10 winners of $1,500 each. However, if you're on this call and you're the parents of a high school junior or younger, watch for the scholarship announcement next year. We send it to all the members. The portal typically opens for applications in January and closes in February or sometimes early March. We email all the members about the opportunity, and we do post it to this page, so you can bookmark this page. We're going to send you all the slides, so you don't have to write these things down. But this is available to you. Okay, and now let's talk about a little bit more about what this means in practice. One of the things we suggest that you do is you kind of conceptualize paying for college as you're using some past money, some present money, and some future money. So the past will be any savings that you have accumulated for this purpose. They could be just in a savings account, or perhaps you've used a 529 plan or a Coverdell plan or some other tax advantage plan to save for college. So anything that you have set aside, whether you, a grandparent, somebody else. Present is going to be what can you cash flow now? And that might be in a payment plan monthly. What could you spare per month? Or what could you spare per year in order to make college possible for your student or yourself? And then future is going to be loans. So you as a parent or your student might be borrowing against their future because college is a good investment. So let's talk a little bit more about each of these. I know I'm going over a lot and these are complicated topics. If you have any questions, do feel free to drop them into the Q&A feature. The chat has been disabled. I can chat at you, so I'll be chatting some of the links out to you. But do feel free to go into the Q&A feature, put questions in at any time, and I will mostly save questions for the end. I do see we have a question or two now, but I'm going to go through what we have and then answer your questions at the end, but you can put them in anytime. Okay, so past income savings. Again, some people on this call may have a 529 plan or a Coverdell or other savings plan that they've been using for their child's college. Or for your own, you can have a 529, for instance, for yourself or your own education. You can change the beneficiary of those. So you do need to have a conversation in your family about making sure that you have a plan that feels fair for all of your children, if that is a concern for you. So if you have more than one child, you don't necessarily want to use up all of the 529 plan if you don't have separate ones, and you kind of want to balance them out probably. But you also can think about your time frame, like maybe you have longer for the other children before they get to college. In terms of the process, it's pretty simple. You want to leave yourself 10 to 14 days between when you initiate the transfer and when your due date is with the school. If you're going to be late, again, communicate with the bursar's office. But if you have any of the kind of standard plans like your Vanguard or your Fidelity or something like that, that you have your 529 in, you can usually do just an electronic transfer to the school. You still want to leave yourself those 2 weeks. But that will simplify the process, make it happen faster, and also allow you to avoid having to do any tax reporting, because if it's paid directly to the school, then you don't have to justify to the IRS that it was an educational expense. Whereas if you have it paid to yourself, you're gonna have to save all those receipts and prove that it was for an educational expense, or else pay the penalty. The other thing to think about is whether or not you want to spend more of your assets down, the 529 assets or any other savings you have, early, so to increase the likelihood of financial aid in later years. So that's a strategy some people use, so that, if you realize you only have a set amount in your 529, maybe you want to spend it all out in year 1 or year 1 and 2, so that maybe for junior, senior year, they might get more financial aid. You just need to think for yourself what feels realistic. You also don't want to get yourself in a position where you're dependent on aid that you don't know if you're getting. So just think about how you want to pace that and what makes sense based on your savings, if you have any. One thing I also suggest for those of you on the call who have younger children or even children in high school, I used a 529 to save for my kids' college. During high school, my kid didn't have a lot of things that they wanted, so the grandparents would always be asking, what should we buy for holidays, that kind of thing, and got my kids' permission, and then asked the grandparents to please give to her 529. Yeah, ours had a link that was very easy. You could send it out to somebody else and that way people could contribute, any amount, $50, $100, something like that. All those gifts can add up and make a difference. So instead of getting something, a gift card or something that your student might not use, that they're going to use those funds. So that can be a nice way to enhance your savings, and the 529 plans make it easy. And there may be also ways to do that through other plans as well. All right, so then present income. So talking about what can you cash flow for your student. That might be a lump sum payment, paying the tuition bill just twice a year, whatever you're able to pay, or a payment plan. So you want to take a look at your college or university website and find out if payment plans are offered. You'll be able to find that information pretty easily on there. For instance, our college offers a no interest monthly payment plan. It does have a small setup fee of $45. You have to enroll by a certain date to have that $45 fee. Otherwise, there's like a late fee if you enroll late. And then you choose whether you want the payments to be on the 10th of the month or the 20th. So during the semester, you would have 5 payments. So visualize it as 10 payments during the year. And so you can kind of divide up the amount that you are owing and think about it in that monthly sense as well. So just as an example for us, that remember I told you that it was 16,000 per year that ends up being billed. If we didn't take any loans, that would be billed, if we want a monthly plan and we didn't take any loans, it would be billed in 10 equal payments of $1,600. So if you didn't have 529 plan or any loans, then, just that would be what you were looking at. Obviously, if you're able to pay, say, I could pay 10,000 from a 529 plan, then that monthly cost would go down to 10 payments of $600. And if my student took loans, maybe a little lower. So there are options to whatever feels realistic to you. There will be a way to figure that out. And then future income. Mentioned that college historically and even today is a great investment in your students' future and their earning potential, ability to be set up to pay back a loan later. So you also, if you are planning to go to college, you may feel like, hey, this is a good investment because I know going to increase my earning potential if I get this master's or this professional degree or certification. So similarly, it may be worth it to take some loans, but we do have some considerations and things for you to think about in terms of that. So for student loans, you basically have two different buckets. The first bucket is federal student loans. Those are direct subsidized and unsubsidized loans, as well as plus loans. Plus loans are loans that are for parents to take, and the parent would be borrowing, not the student. Direct subsidized or unsubsidized are for undergraduates and they borrow them directly. Plus is parents or graduate students for yourself. So plus loans are the way that graduate students borrow money through the federal government. Federal loans tend to offer more repayment, forgiveness, and deferment options. A lot of things are in flux right now about the student loan repayment programs such as this. However, we did have a webinar earlier this year with a expert from TISLA, the Institute of Student Loan Advisors. And one of the things that she said that I found very reassuring is that Congress has never removed totally a repayment, forgiveness, or deferment option once it's offered to borrowers. They have only cut it off for sometimes for future borrowers. There is some she did share with us that there's some political will to perhaps trim down the number of programs for repayment forgiveness, but it may just be that everyone's put in more similar programs. So we can't see the future. However, in general, federal student loans are a great start. They tend to have a lower interest rate, more options, and you want to take first any federal loans that you're eligible for. Then, if there's additional amounts that you do need to borrow, that's when you're looking at private loans. If your student's going to school this year, now's a great time to start shopping around to figure out if you're going to need a private loan or if you yourself will need one. And again, those can be loans where the student takes the loan, the parent or a family member takes the loan. And you may find lower rates on some of those private loans as well, and different loan terms. So you want to take a look at that. I know when I went to graduate school, I took both PLUS and student loans and had a mixture of the federal ones. I prioritized, for me, the private loans were a higher interest rate, and I prioritized paying those first. And then, just paying the minimum on my federal until I had the private paid off. But that was a while ago, so different times a little bit. Okay. Just to go a little bit more into federal direct subsidized or unsubsidized loans. Some of you on the call may be more familiar with the term Stafford loans. They used to be known as Stafford loans. So if that's what you remember, we're talking about essentially the same thing. For federal loans, you're going to have a fixed interest rate. The rate for next year's class of 2025, 2026 has not been announced yet. However, it is projected to decrease slightly. So the current fixed interest rate for undergraduates is 6.53, and it's been projected that it's going to go down to 6.39 for undergraduates. And same thing for graduates. It's currently at 8.08. It's projected to go down to 7.94% interest for graduate students for the coming school year. So for undergrads at these rates, every $10,000 borrowed will lead to $113 a month student loan repayment after graduation. So for every 10,000 you borrow, you have $113 in monthly student loan repayments. So 20,000 would be double that if you had a 10-year repayment plan. You can choose different repayment plans. And we're going to give you some resources about trying to figure all that out. For that $10,000 over 10 years with this interest rate, you would be repaying about $13,600 over the decade. So it's another $3,600 on top of the $10,000 you're borrowing. So again, you want to minimize loans if you can. However, they may be very well worth it, and you may need to take loans. One thing to keep in mind is that your loans are deferred while your student is enrolled at least half-time. If something happens and your student is going to be going below part-time, going to part-time, going below half-time, you're going to need to be in touch with your loan servicer. You can also talk to your college financial aid office and get some advice there. And we're going to give you a free financial counseling option as well for these things. You do have a 6-month grace period when you graduate before you have to start making payments. If you are able to, while you're in school, or even during that grace period when you graduate, if you're able to pay the interest on your student loans, you will be really happy with yourself later, because you'll save yourself a lot of money if you're able to at least just make interest payments. For instance, some students use that federal work study money to make some interest payments while they're in school. The other thing to know is that there is a loan fee for these direct subsidized and unsubsidized loans. Your loan fee is going to be 1.057%. So if most students are eligible for a $5,500 loan as an undergraduate. However, their school's only going to get 5,442 of that because of the loan fee. So typically your financial aid package is going to show all that, but you may need to be aware that you may need to make up a difference between the loan because of the loan fee. And that's just something you want to keep in mind. All right. So as I mentioned, there's a limit to what is offered for federal direct subsidized and unsubsidized loans. For first-year students, undergraduate, if they are a dependent, most students are going to be offered that $5,500. I do want to clarify, this is not the same word definition of dependent that the IRS uses. So, for instance, if you're divorced parents, and one spouse claims them as a dependent, maybe you don't. That's not what they are worried about. If your student is dependent on their parents or guardians for food, shelter, etc., they're a dependent for these purposes. The only students who are going to typically qualify as independent students are students who have been in foster care, students who have served in the military, students who are married, or students who are much older. Those are independent students. They can qualify for more loans, eligible for up to $9,500. And then those amounts do increase for future years, which is nice to know, because a lot of scholarships that you get, my kid got a scholarship through our city, and it was just for the first year. So sometimes you do need more loans in future years. That is fairly typical, that you might have some scholarships that are just a one-time payment. for freshman year. And then we have aggregate limits for the total amount of time you're in school. So you want to kind of keep that in mind, especially if you're running into a situation where your student's not going to graduate within the 4 years and they need an extra semester. You don't want to tap out all your loan money, or you just want to be aware and talking with your financial aid office if that's the case, I guess. Okay, and then the PLUS loans, which I mentioned, are the loans that are available through the federal government, either for the parents of students. So say the student took that $5,500 loan, it's not quite enough with the financial aid to meet the full tuition amount, and you need to take a loan as a parent. That PLUS loan is available to you. Your student must complete their free application for student aid, or commonly known as the FAFSA, in order for you to get that PLUS loan. Same thing for them to be able to get that direct loan themselves. They need to have the FAFSA done. So I hope anyone on this call whose student is going next year has done their FAFSA. If not, do that ASAP. Because that's going to be eligibility for a lot of things. And then there's no grace period for the parents because the assumption is that, you're working. But if there's a need, there may be, you may be able to request deferment. So I'm going to give you a resource about that as well. So just remember that if you, the parent, borrows, you are responsible to pay the PLUS loan, not your student. So that is just something that you do want to keep in mind, that you don't want to be borrowing more than you can afford. You want to be thinking realistically about repayment for yourself. And there's also PLUS loans for graduate students. I had one of those myself. It does have a 6-month deferral grace period from when you graduate school. These are the projected interest rates. Again, they're not out yet, but this is what they're projecting for interest rates for next year. It's currently at 9.08%, but they're projecting it'll go down a bit to 8.94. These do have a higher loan fee. So if you borrow $10,000, your fee is going to end up being $422.80. Any money that you borrow as a federal loan, it's paid directly to the school. So that's a nice feature. However, due to the fee, if you borrow that $10,000, the school will only get 10,000 minus 422, so 9,577. So you either have to borrow additional funds to cover the fee or pay the difference. This is usually reflected in your tuition bill, but just something to be aware of because occasionally it's not, depending on the school. All right. If you are denied a federal Parent Plus loan, there is an appeal process to the Department of Education. So you can appeal, or if you still need that loan and the appeal's not working, or you want to investigate other options, you can look for a co-signer, someone who has better credit. So those are both options. They both do require a approximately 30-minute online credit counseling course before that happens, and just to make everyone aware of what the obligations are, and again that the co-signer is putting extending their credit and on the line if that's not repaid. So that's why there is required counseling for that. If you want to know what your student is going to be offered for federal student aid for all the loans that we've been talking about, those federal loans, you're going to go to studentaid.gov, and that's where your student will be able to see the amounts, the rates that are being offered, the terms. It's the same place you filled out the FAFSA, and lots of information on there, and that you can go in and manage your loans there as well. So then we talked about private loans. So many banks, credit unions, and even some private companies will offer private student loans. Those may be money that you take in addition to the $5,500 a year, roughly, that you're taking from the federal government. I do recommend credit unions. I feel like we are very upfront about our fees and terms, and that's something kind of typical of the credit union movement. That's one of the benefits because it is by the members for the members. And your terms are going to vary depending on the lender. So you can shop around for interest rates, the terms that feel good to you, the grace periods that are right for you. There may be potential benefits with different options. For instance, at our credit union, we do have a cosigner release option. If you make on-time payments for a certain number of years, then the cosigner and have good credit and establish and create good credit, your cosigner may be able to be released at a later date. Also, many places, including Harvard FCU, offer an interest rate reduction for auto pay. So those are some things that you can look at for those private student loans. If you do want to check your credit before you go out and apply, we definitely recommend you do that. One way you can do it, I'm going to give you another way if you're a member of the credit union, but if you are not a member of the credit union, this is a way to get your credit for free. It's annualcreditreport.com. They are authorized by the federal government, and they provide your credit report from the 3 credit bureaus for free. So that's a good place to check, make sure things are accurate on your credit report and that there are no debts or information on there that is incorrect, that's misattributed to you. And I'll give you a resource shortly if you do find something like that. Another thing that is a little bit less clunky and easier if you are a member of the credit union, we do have Savvy Money, right in online banking. You can sign up. Again, it's free. It does not affect your credit to look at. You can look at it every day. And it does show you not only your credit score, annualcreditreport.com is going to show you your report, but not necessarily your score. So many banks or credit cards will offer your score. The way we do it is through Savvy Money. But the thing that's great about Savvy Money that not everyone has is it has all kinds of information about suggestions about how to improve your score. A simulator where you can say, well, what would happen if I did this? If I closed a credit card, would that improve my score or harm it? In general, it will harm it. You do want to keep credit open if you're able to for longer amounts of time. What about if I made on-time payments for a year? Would that improve how much would that increase my score? So there's a great simulator on there. Again, it's soft pull, so no impact on your credit score. So it's just a great free benefit for our members. So check out Savvy Money. You also can think about non-educational loan options. For example, my parents took out a home equity loan to help finance my college. They had enough equity in their home. They decided that was better. It may have tax advantages, depending on what kind of loan you get. However, in the case of the HELOC or home equity loan, your home is your collateral, so you do not want to take more than you can afford. I mean, in general, with all these loans, you don't want to take more than you can afford, but particularly when your home's on the line. Also think about that. What if you needed funds for an emergency, like home repair, or something happened with your house and you needed the money? Now you cannot draw on that equity if you've already drawn on it for another purpose. Finally, does it impact your retirement age at all to be taking more loans? They always say you can't borrow for your retirement typically, but students can borrow for school. So just think through, there may be loans that you do want to take, but make sure that they are affordable to you and realistic for you. So just to recap, the loan factors to consider are the amount you need. So cost of attendance minus the aid is what you're going to need to be paying. How much do you need to take in a loan versus what you can cash flow? Any fees, types of interest rates, who's going to borrow, student, parent, Are there going to be co-signers? Are there any prepayment penalties? I personally do not like to take a loan that has prepayment penalties. I want to be able to pay back the loan more quickly if I'm able to. I took 15-year loans for grad school and paid everything back in about 12 years, and that felt great because then I was able to do other things I wanted to with my money. So when you're applying for the loan, you can, there is a process. So keep in mind, this is not going to be overnight, and you do need to get ready for whenever your college deadlines are that you found out. So for instance, there's the application process. You may need to provide documents. The student will need to complete additional documents, usually required counseling, sometimes just simple online, and loan acceptance paperwork. If they're accepting any of their loans, then the institution is notified of the approval and the amount, and the funds are dispersed at a later date. So that's for any educational loans. If you're doing non-educational loans, typically the money is going to be sent to the borrower, you or your student, and then you are responsible to send it to the college. So that's just something to keep in mind too. For time, it might take a little longer. So we do have education lending at the credit union, and I'm going to send all these links to you as well. I know most of the people on this call are from Beth Israel Lahey, and we did want to call out that Beth Israel Lahey Health does have tuition reimbursement if you yourself are going back to school. So this is not for your child, but yourself. You can research your eligibility for tuition reimbursement through your employer. In this case, Beth Israel Lahey uses Sentinel Group, and that's a way to apply for tuition assistance related to your associate's degree, bachelor's, master's degree program, or direct patient care continuing education unit. So you can look at all the program instructions there and find out more about your eligibility for that. A lot of the things that we are mentioning have tax implications. And so if you want to find out any tax implications for scholarships or loans or anything like that, you might want to check out the IRS publication 970. I will send you this link. Everyone who's registered will get these links as well. Finally, I've been telegraphing that we're going to give you some resources. And so this is one of the main resources that we offer. If you've been to any of our financial workshops in the past, Green Path is one of the main things that we do recommend. Green Path is a nonprofit partner with the credit union. You do not have to be a member of Harvard FCU to get help from Green Path. Just by being on this call and coming to a financial wellness education, we extend to you the right to contact Green Path for free credit counseling if you want to try and improve your credit before you apply for loans, debt counseling, if you need a plan, maybe you're a few years out from college and you want to plan for paying off debt and getting ready. Student loan counseling, they're certified student loan counselors, certified HUD housing counselors. They can help you make a budget. So Green Path is a great resource. They're available extended business hours in many languages. First step would be to go to this website and get access to Green Path for yourself or for your student. Some other resources that I like to mention, if you're in Massachusetts, there's a great organization called MIFA, the Mass Educational Finance Association. They have lots of information about state programs for financing education. There's also TISLA, which I mentioned earlier, the Institute of Student Loan Advice. That's more for people who do already have loans, but they provide free advice to students by certified student loan advisors by email. So TISLA is also a great resource. You can Google TISLA, and I will also send that as a link as well. And this free counseling at Green Path is available to you as a parent, if you're going to get one of those Parent Plus loans or Graduate Plus loan for yourself, or for your student, for them to get free counseling as well. So I definitely recommend Green Path and the other resources I've mentioned. We do have a blog that has lots of information on these topics. We are going to send you a survey link as well, or you can go to this link now for harvardfcu.org/survey to give your feedback. We do really appreciate your honest feedback on our webinars and workshops. It does help us to improve them. So please submit your feedback. We'd love to hear it, and we do read everything. I'm going to go ahead and suggest that anyone who has a question can go ahead and put it into the chat. I think I answered the question that we had. I do want to mention that we do not provide tax, legal, or investment advice, so we're kind of directing you to places you can get that advice. But this is not specific advice for your situation or expert advice. Last thing I just want to mention is that we do have a new branch that's going to be opening up in Longwood area. We're really excited. So for those of you over at the hospital, we're going to be opening a branch at 1620 Tremont Street. It's also known as 1 Brigham Circle this summer, and really excited to have you come visit us there. We're going to be having some publicizing some giveaways and things to encourage you to drop by the branch and see our friendly branch staff. And this is how you can keep in touch with us. We are harvardfcu.org on Harvard FCU as a handle on all the socials as well. So we do put out lots of regular information on financial wellness through those channels. So feel free to follow us if those are good ways for you to get financial information. And so then just going back to any questions? So this person is asking, so you've been mentioning your child is in-state tuition. So how much does out-of-state tuition vary? Again, that's all going to be on the published billed costs that the college puts out. There should be billed costs for in-state students and out-of-state for the state schools. Typically, there's no difference when you're at a private school for in-state versus out-of-state. So take a look at that and you will be able to find out the answer to your question. I don't know off the top of my head. I do know that we looked at, my child got into Rutgers and we looked at out-of-state tuition there. And I want to say it was 20,000 more for them to go to Rutgers. And we visited and met some very nice people in the astrophysics department, graduate students, and they said, for graduate school, it really matters, but for undergrad, where you study, because you want to study with a professor that does the research you care about. But for undergrad, go to your state school, UMass is the same as Rutgers. That was their opinion. Anyway, so look at the cost of attendance, you'll find the answer to that. Not seeing any other questions right now. So thank you very much for joining us. We really appreciate you taking time out of your day to enhance your financial wellness. I am going to send out all those links, but I will just drop into the chat now the survey link in particular, because we would love to have your feedback. So if you're able to complete a survey for us, we would very much appreciate that. And then I will drop into the chat right now the GreenPath link that I was mentioning. This is where you can get free counseling. You don't have to be a credit union member to get the free counseling from GreenPath. It's also really good for when your student's graduating or you are graduating to choose repayment options. Their certified student loan advisors can help you with what option do you choose, because there's all these different repayment options. We did mention studentaid.gov. This is where you apply for your FAFSA, free application for federal student aid. So you can go ahead and go on there if you want to check how much in loans or aid your student is eligible for. We mentioned annualcreditreport.com, and they are here. And the Harvard FCU scholarship is here as well. So you can bookmark that for next year if your student will be attending next year. Here's our educational lending link. That's the general one, and there's a page, you can find it on there for graduate versus undergraduate. And then we have some programs that are specifically associated with schools at Harvard. Here is the Sentinel benefits for Beth Israel Leahy for tuition reimbursement if you yourself are going back to school. And here's IRS publication 970. That's about tax implications. I think that's all the links I mentioned, but we will email them out as well. So thank you very much and enjoy the rest of your day, everyone.